Hey folks, welcome to Quantsap. Today we will learn about two unique option trading strategies which are not used by a lot of traders. These strategies are generally overlooked by a lot of option traders. So we will learn about the strip and the strap option trading strategy. So do check out the video till the very end. So these strategies, they are most likely either way strategies, meaning when you expect some kind of movement to happen in the market on either of the side, either on the bullish side or on the bearish side, we will deploy such type of strategies. Benefit of doing this is that market goes in any of the direction, we would still end up making money. But the another aspect is that if the market doesn't make any move and if the market remains in a range, then we might end up paying a big theta to the market. So whenever we are deploying such type of strategies wherein we are buying options a lot, at that time I'll make sure that I do not hold my option trading strategy for more than 3 days. Okay, maximum 3 days when I'm doing specifically something like a long straddle, a strip, or a strap option trading strategy. Okay, so the reason is because I would be net heavy theta loss is what I will witness. So let me just take you to Architect and just show you how the strategies look like. So Architect, you can access it from the link in the description box below. Anybody who has signed up to Quantsap can access Architect. So select the expiry, select the instrument, let's say 28 September expiry, and I'm selecting custom strategy. Okay, so this is all new and user friendly user interface of Architect, wherein we are also showing the open interest. The green color bars are showing us call options OI and the red color bars are showing us put options OI. So this becomes now very easy for me. Let's say if I'm expecting 2500 is what I'm expecting on Nifty.
Hey traders, Quantsap has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
Just by looking at the options open interest data. So I can easily see that if market goes to 2500, how much PNL I would make here. So we don't need to actually guess any levels. We can simply open options OI on the Architect itself and see where the highest call and where the highest put is, and basically just to check if we make money at our target level. We can also hide the options open interest data. If we want, we can see the standard deviations as well. So market expected lower bounds, upper bounds, and plus to standard deviation and minus to standard deviations. So okay, now this is a simple long call. Now if I'm bullish on market, this is typically what I'll deploy. But I am not bullish on the market. I have a either ways view on the market. So I'll add one more leg of the same strike price, but I will use a put option for that. So let's say put option. And now if I increase, let's say 2200. Now this becomes a long straddle. What I have done, I have bought both call and put option. Of 2200 call I have bought and 2200 put I have bought. Market going on either of the sides, I'll still end up making money in the market. Now the problem with this strategy is that if the market remains in a range, then I might end up paying a lot of theta to the market. Let's say till expiry, if market remains at 2180, which is approximately 40 points from here. If the market remains where it is, I'll end up making a loss of 6000 rupees. So the only problem with such type of strategies, which I mentioned already, is such that if market remains in a range, then we might end up paying a lot of theta to the market. Apart from that, let's just see of 20th April or 28th September expiry. Here we go. Now let's say if I hold this strategy for 3 days. Now if you see T plus 3 PNL, that means from current day from here, if I hold the strategy for 3 days, I'll make roughly a loss of 2000 rupees. So whenever if I want to do anything with respect to a volatile movement happening in the market, it is better I choose a expiry which is slightly far away. I won't go very far away wherein I'm not choosing the October expiries, but I will go a little bit far away so that I end up paying less theta to the market. So this is a small thing what we can do. Let's say if the expiry is tomorrow, I will not create a trade in tomorrow's expiry. Instead, I will create the same trade in the next weekly expiry. Now again, the idea of doing this is that if there is any big movement happening in the market in next 2 days or next 3 days, I'll still end up making money on either of the side. Now, break even 1, break even 2. It's self-explanatory. For me to make money, 3 days from here, market should go below this level 2043 or market should go above this level 2357. Now let's say I have a either ways view on the market. Okay, that means let's take a scenario that I'm expecting that the market might fall, but it also has a bit probability of moving up, but it will not remain in a range. Okay, so what is my assumption? That market has likely chance of going down. It has, let's say, 60% of chance market has it might go down. 60% probability is that the market might go down, but it won't halt if it doesn't fall. Okay, instead it may go up. So first thing is that the market might not remain where it is. Second thing is 60% chances are that the market might fall from here. Rest 40% is such that the market might move up. So in that type of forecast, wherein I am mildly bearish on the market while having an either ways forecast, what I'll do is I'll add one more quantity. I'll basically create a trade twice the quantities on the put side, and I will basically hedge it. Now if you see, let's say 20,200. If you see, it has converted into a strip option trading strategy. So what is strip option trading strategy? Simple, you are buying one lot of call options and in front of that you are selling two lot of put options, and this is how the payoff will typically look like. Again, the problem here again would be that you can't hold this also strategy for 10 days or 15 days. Eventually the theta is going to hurt you a lot. So that is the reason even in this strategy we will remain in the strategy for some time, elsewhere we will exit if the move doesn't play out. So the best part about this is that let's say if you are expecting bearishness to happen in the market, but even if market goes up from there now, still we might end up making some kind of money from the market. Obviously if market falls from here when you are creating a strip strategy, then you are going to make a lot of money. So you can analyze the payoff looking at this particular level. Now let's turn it back to normal. It would be again a 1:2 ratio depending on how much quantities you trade. If you trade 10 lots, we will create a 10 lot trade on call and we will create a 20 lot trade on put. Okay, it would be 1:2. Now let's say if I have a mildly bullish view on the underlying, what I'll do, I'll buy 2 lots of call option and only 1 lot of put option. Again, be cautious. I will not hold this strategy for more than 3 days. Okay. So this is how it will look like. If I just hover my cursor, then we will get to see on what various levels of Nifty, how much profit or loss we might end up making. This is a strap option trading strategy wherein my view is either ways. If I just hover my cursor, then I'll get to see. So yes folks, that was it from this video. So these strategies are generally used when we are expecting either ways movement in the market with some sort of directional bias. Do check out Architect tool as well and analyze any of your option trading strategies very easily. Thank you.